Welcome back to another video from Joe's Finance Fundamentals. This video is titled How to Invest Part 2, and I will go a little deeper into such topics as how many companies are in the U.S. stock exchanges, how is a stock price determined, what is a mutual fund, what is the difference between an active and passive mutual fund, and how to choose a mutual fund. That will lead into my next video, How to Invest Part 3, where I will be talking about specific mutual funds to meet specific investment objectives. Now, whole books have been written about each of these topics, so I will kind of focus on the basics. Because, as it seems to me, a lot of folks, especially young people, are not sure where to begin, having never been taught this in most schools. Before I get started, my normal disclaimer that this information is intended only to provide general financial education for informational purposes only. The information and opinions within should not be regarded as objective facts. This content does not provide financial, tax, legal, or any professional advice. Personal financial decisions should not be implemented based on the content of this site. Do not act upon any information without first consulting a licensed investment, tax, or legal professional. Before I get into the fundamentals of the stock exchanges, I want to give you a quick story about how I get started. And I ended my last video, How to Invest Part 1, with a story about how I found out about Vanguard in the newspaper and began investing into their mutual funds once I started working after college in the late 1980s. Actually, my investing experience starts before that. See, during high school, I was a paper boy, getting up each day to deliver newspapers before school. On the weekends, I had to go around to my customers to collect the money they owed for the paper. And it turns out I made pretty good money back then for a high school kid, probably in the neighborhood of about $150 a month, if I can remember correctly. That was a long time ago. Having a saver mentality, at some point I wanted to do something with this extra money, besides putting it in my passbook savings account at the bank. I wanted to see it grow into even more money. I think my dad at the time had a stockbroker, and so he talked to him. I don't remember ever talking to him. I was probably too afraid to talk to this gruff old cigar-smoking stockbroker. Anyway, the broker gave me or my dad some stocks to invest in, and I mailed in the money. Over a period of 2 to 3 years, I don't think I really made any money, but I did get a taste of investing my hard-earned money in the stock market and relying on someone else to make decisions for me based on their quote-unquote expertise. Anyway, with that background, let's talk more about stocks and a little bit about bonds as well, and then we'll get into mutual funds. There are two major stock exchanges in the U.S., both located or headquartered in New York City, commonly known as Wall Street. The first exchange, New York Stock Exchange. Second one is the NASDAQ. And in total, between those two exchanges, about 6,000 companies are listed on these exchanges. That means they're publicly traded. Companies listed on these exchanges have issued a certain number of shares of stock, which are publicly traded each day. These shares constitute ownership of the company. Owning more shares equals more ownership. The number of shares of stock issued multiplied by the price per share equals the company's market valuation. For example, a company with 1 million shares outstanding and a share price of $10 a share, that company is worth $10 million in the eyes of the market. Apple, Microsoft, and several other companies are actually worth more than $1 trillion. Wall Street has developed three ways to keep track of how the stock market is doing because having 6,000 stocks is just too many to keep track of to present overall summary of how the market is doing. So there's three ways that three common indexes that are used. The first one is the Dow Jones Industrial Average, and that consists of 30 stocks from both the New York Stock Exchange and NASDAQ that are representative of the entire stock market. So you have companies like Apple, Coke, Disney, Microsoft, Home Depot, McDonald's, Walmart, Nike as part of these 30 stocks, as part of the Dow Jones Industrial Average. Ironically, there's not a chain, those 30 stocks are kept the same most of the time. However, from time to time, a stock is added or a stock is subtracted. And I think in a few days, at the end of this month, as a matter of fact, Amazon will be added and Walgreens will be taken out. The second index is the NASDAQ Composite Index. So that's somehow they calculate a weighted average of all the stocks in the NASDAQ. The third way, and one of the most common ways, and one of my favorite metrics, and probably my favorite metric, is the S&P 500. It's a weighted average of the 500 most valuable companies across both exchanges. As of February 2024, the top 5 companies and their weighted average of the S&P 500 are Microsoft at about 7.15%, Apple, Nvidia, Amazon, and Meta, as you can see here. Those top 5 are almost 25% of the index, which is a lot, and some folks are worried about that, but the S&P 500 index still remains one of the closely watched indexes for how the market is doing. Common question I hear is a company with a higher stock price better or more valuable than a company with a lower stock price? What do you think the answer is? Not necessarily. For example, a company with a stock price of $500 a share and 1 million shares outstanding has a market value of $500 million. So you can invest $500 and you will be able to buy 1 share. Company B might have a share price or a stock price of $5 a share, and they have 100 million shares outstanding. That has the same market value of $500 million. So your same $500, instead of buying you 1 share in Company A, could buy you 100 shares in Company B. It's still the same $500. There's no difference. A company's stock price changes every day as people, by people I mean individual investors like ourselves, mutual fund money managers, pension plans, etc. They buy and sell stock every day. So that's what determines what the stock price does every day. So in order to buy a stock, or in order for there to be a transaction, there must be both a buyer and a seller. And the price change every day is determined by how many of each there are. So for example, if more people want to buy the stock than sell it, the price will go up. If more people want to sell the stock than buy it, the price will go down. Therefore, company stock prices can fluctuate a lot in one day. And so it's really no different than selling something on eBay and you put it out to bid. If it's an attractive item, you're going to get a lot of bidders, well, that price will go up. If it's not an attractive item and you don't get any bidders, you have to lower that price in order to get some bidders. That's the same supply-demand concept here with the stock market. Some companies also will pay you to own their stock. This is called a dividend. Dividends are usually paid quarterly, and you can either take the cash or reinvest that cash to buy more shares of the company. That's called dividend reinvestment. Most of the companies that pay a dividend have been around a long time. and are fairly stable companies. So they make money both when the economy is doing well and not so well. So, for example, most banks pay dividends, utilities, many consumer products like Procter and Gamble and Coke, as an example, mobile phone carriers like Verizon. Those companies pay pretty good dividends. The share prices, because those companies don't necessarily grow as fast as, say, tech companies, their share prices tend not to change as much as they do for some other high growth companies. And finally, bonds are another type of investment often viewed to be safer than stocks. They are issued by governments and companies to raise money, and they pay a specific interest rate over a specific time period, which is usually years. So by buying a bond, you are giving the issuer a loan. In addition to the periodic interest payments they will provide you, the buyer of the bond receives the face value back at the end of the period. So if you give, $5,000 toward a bond, you'll get that $5,000 back at the end of the period, however long the bond is issued for, in addition to getting interest every quarter or maybe twice a year, maybe once a year. Bonds can be a part of your overall investment strategy and portfolio to seek diversification and balance and reduce the volatility of your investments. So I'm going to switch now over to mutual funds, and I'm actually going to go directly to Vanguard's website, and we can look to see what they have to say about what is a mutual fund, what is the difference between an active and passive mutual fund. Another name for a passive mutual fund is an index fund, and how to choose a mutual fund. Now, I'm only going to Vanguard's site because I'm most familiar with them, but I'm sure if you went to other websites from other companies such as Fidelity, Charles Schwab, BlackRock, T. Rowe Price, or a few that I know of, I'm sure you'll find similar information. But I'm most familiar with Vanguard, having been investing with them for over 35 years. So I'm going to get out of this presentation and jump over to the Vanguard website. Very quick at the top here, you can see the different products and services they offer. The investment products, I'm going to go in and we'll talk about mutual funds. But you might see different things we've already talked about in previous videos, like IRAs, 529 plans, etc. And a lot of things we haven't talked about. Vanguard also gives you information about why they're different, etc., and some of the other things. But I wanted to go over resources and education because there's a lot of information out there that you can explore your own goals. We talk about retirement, education, emergency funds, etc., choosing investments. There's lots of good information out there. I'm going to go into mutual funds. Scroll down a bit here. What is a mutual fund? And simply stated, Vanguard is saying a mutual fund is a collection of investors' money that fund managers use to invest in stocks, bonds, and other securities. That's why I wanted to introduce to you a little bit about stocks and bonds, if you didn't know already, because that's what all a mutual fund is a collection of people's money that people send their money in, and there are specific funds, which we're going to take a look at a couple here, that Vanguard's fund managers will use to invest in stocks and bonds primarily. Now, mutual funds have a cost associated with them. Vanguard talks about, and I've talked about it in previous videos, about how they are known for their low-cost mutual funds. Another benefit of mutual funds is one mutual fund can invest in hundreds, sometimes thousands of individual securities. That more or less means stocks and bonds. So one mutual fund can invest in hundreds or thousands of individual securities at once. So if any one of those does poorly, the others are there to help offset the risk. That's what I like about them. Less risk through more diversification. They talk a little bit about professional management, convenience, and the Vanguard difference, as they say, because Vanguard itself is not a publicly traded company, they're able to keep their costs low. If I scroll down here, here's really kind of where I wanted to focus on today, the difference between passive funds or index funds and actively managed funds. If I click on the view the index funds here, Vanguard offers, as you can see, 132 different index funds. So there's all sorts of different types of them, right? And you can kind of filter and use these buttons here to filter stocks, fixed income, money market, balanced, sector, specialty are the different types of index funds. Most of them are stock index funds. And I just wanted to focus on one of them because I was talking earlier about the S&P 500. So I can buy, and this is one that I own, is the 500 index fund. And this fund, as you can imagine, invests in every single company in the S&P 500. And it invests in the weighted average. So, I talked earlier, I showed Microsoft being number one and Apple number two and so forth and so on. And if I go to the portfolio composition here of this index fund and scroll down a little bit, you'll see their holdings. So these top five should match up pretty close, if not exactly, I believe. And they will shift, once in a while. Somebody will jump over somebody else or whatever. But so the 500 index mutual fund, their holdings are exactly the same weightings, right? So that means the number one company of Microsoft in the S&P 500 is the number one company, biggest holding of the 500 index fund. Okay, and so forth and so on. Another thing I like about index funds, I'm going to scroll back up here a second and talk about the cost of the fund. I guess I could have probably clicked on performance and fees. Index funds are known to be very low cost. And I'm just looking for it here, right here. Expense ratio, 0.04%. So that means, if my math is correct, for every $1,000 you invest, every year they'll charge you 4 cents. I believe is that math, and so that's very low, 0.04% on index funds. So that's another good thing about index funds is there's very low costs. I want to shift over to risk scale. Another thing I like about Vanguard is, and I'm going to talk more about this in the next video, how to invest part 3 around risk and reward. So Vanguard says, a fund that has low risk reward is a 1, conservative, up to 5, which is an aggressive fund with more risk. So if I just want to see their conservative funds, generally these will be what are called money market funds. And you can see a lot of these are bond funds that I talked about earlier. But I do want to get to, if I can find it, the money market funds. I'm not able to find it right now. Let me see if I can. Yeah, I think that's categorized as an active fund. So there's a fund called the Federal Money Market Fund. So when I talk about building an emergency fund, this is what I've used, is just a basic money market fund. And this is the least risky, but you'll get the least reward. However, right now it's paying 5.27% a year. It's an annual percentage rate. That's pretty darn good. With the interest rates being high, that's not a bad place to be putting your money at the moment. And again, it's a very, very safe investment. They are investing in U.S. government bonds, basically. I'm just going to scroll down here so you can see that. Yeah, and they don't really show it here, the specifics of the portfolio composition. Here I can show it actually. U.S. government obligations, U.S. Treasury bills, and I'm not sure what a repurchase agreement is, but I'm sure it's pretty safe. So that's one example of a fund on the really safe side. An example of a fund on the riskier side, and now I'll switch into an explanation about what an active fund is. An active fund means that it's a fund where there's money managers picking specific stocks. So an index fund, they're not really picking those stocks. They're whatever's in that index, they're owning them. Active funds, again, they are picking specific stocks. I'm going to scroll down here and find an active stock mutual fund here, one that I'm familiar with and I have owned in the past. I don't own it anymore. It's called the PrimeCap Fund. You can see the risk reward at number 5. The reason I don't own it anymore is because as I'm getting a little bit older, nearing retirement, I wanted to have a little bit less risky fund. For a younger person, though, this fund, unfortunately, it's closed to new investors, which kind of typically means it's done really, really well. Now, you can see it has a higher expense ratio. Remember, the S&P 500 index fund was 0.04. This is 0.31%. It's still pretty low, but it is going to be higher. Now, with an active fund, when I look at portfolio composition, there's lots of data here you can look at. This mutual fund owns 170 stocks. So that's kind of on the low end for a mutual fund. And there's a strategy about this fund, and they'll talk about that they invest in, and you're going to be able to see it here, mostly healthcare. 31% of this fund is healthcare. Roughly 30% is IT or technology. So 60% of this fund, generally speaking, stays within healthcare and technology. That's pretty risky. It's pretty weighted heavily in those sectors. And you can see the top 10 companies, and I don't know what percent of the overall mutual fund is in these top 10, but I would guess it's probably close to 40% of the value of the mutual fund is in these top 10. So these top 10 go up and down their share prices. The share price of this mutual fund will go up and down also. But you can see these companies. They may or may not to appeal to you, but at least with an active mutual fund, for any one of these, for any of the active mutual funds, you can look at which stocks or bonds, most of the time stocks, that they are selecting. Here's another one, Vanguard Strategic Equity Fund. I don't know a whole lot about this fund, so let's see what types of companies they're investing in. So these look to be smaller companies. Haven't heard of most of these companies. So, I might be a little bit reticent to invest in a mutual fund where there's companies I don't know a whole lot about, or, maybe that's a risk I'm willing to take. So anyway, that was a quick overview of, Vanguard and some of their mutual funds and active versus passive. On my next video, How to Invest Part 3, I'm going to go over specific investment recommendations and specific investments that I've used in and I've mentioned a few of those already today, but I'll mention some more that I've used in my portfolio over the years based on my investment objective, like do I want to build college savings, do I want to save for a house, and so forth. And what's my time horizon? Do I, need the money in 2 years, or don't I need it for 20 years if I'm saving for retirement, for example? So we'll go over all of those in the next video, How to Invest Part 3. Thanks for watching. Please submit your comments and talk soon. Bye-bye.